Hello everyone and welcome back to Option Alpha. In tonight's video we're going to talk about the top 3 strategies you can use for monthly income with your options trading. Now, as we always talk about on this blog and on our website, we're not talking about trading options for home runs. Not those big risky trades where you buy options way out of the money and you hope and pray and beg and plead that the option makes a move in a short period of time for you to make money. That's not what we're talking about here tonight. Instead, we're talking about hitting consistent singles, really the options trading strategies that produce money month after month after month. And really, we're talking about odds and probability trading. Again, not hopes and dreams and prayers. We're talking about trading options on odds and historical probabilities. This is absolutely by far the best way you can trade options and by far the most consistent for income. So the first strategy we're going to talk about tonight is credit spreads. And I'm going to throw up a payoff diagram here before we talk about an actual stock chart. So here you can see the payoff diagram for a typical credit spread. And usually in a credit spread, what we'd be doing is buying one option and selling another option at a higher or lower strike price. In this particular instance, we're doing a credit spread below the market, hoping that the stock price at expiration is above 45. So you can see that we have bought an option at a 40 strike price, and we've sold an option at a 45 strike price. Usually this will be a put option if it's below the market. And so what we've done here is created this simple payoff diagram that says, okay, if the stock trades anywhere above about 42 or 45 at expiration, we get to keep our entire premium that we made for income. If the stock does happen to trade below 42 and below 40 at expiration, then we just lose a little bit of money and our downside risk is limited to just $200. So let's take a look at a stock chart right now and see how this can apply to a current market situation. Okay, so here's a current stock chart. Now we don't have any date or any ticker symbol on this stock chart, just for illustration purposes only. So you don't know which chart it is, but let's just say that we're looking at a stock that's trading right around $50 right now. So if we thought that the expectations for this stock were to be continuously bullish, i.e. that it would continue to be bullish and rise, or that it would trade relatively flat to sideways, we could create a credit spread at a 45 and 40 strike put options. So again, we would be selling the 45 strike put and buying the 40 strike put. Now again, our break-even price is right around a 42 price level, so as long as this particular stock trades above the 42 price level all the way until expiration, and this should usually be about a 30-day trade, then we would get to keep all of the premium that we received. So you can see this is definitely much more of a better type of options trading strategy rather than buying a call option or buying a put option, because even though the stock is trading well above our strike prices, the stock could rally, trade sideways, or even trade down into expiration, and we would still collect our entire premium. So this is by far one of the best strategies that you can use for monthly income with options trading. Now let's take a look at another strategy you can use. Alright, the next strategy you can use for monthly income with options is iron condors. Now these are a little bit more of a hybrid as compared to the credit spreads that we just looked at, but here's the payoff diagram. And you can see it looks very similar, other than the fact that it looks like we have two exact credit spreads, but one on either end. So instead of making a more directional play on the market, i.e. thinking that the market will rally or fall, we're actually assuming that the market stays within a pretty tight, narrow range here during expiration. So in this particular instance, we've created a credit spread on the lower half with puts, and we've also created a credit spread on the upper half with calls. And basically what we're saying here is that we're going to profit about $200 so long as the security trades in between 50 and 40 at expiration. So it can trade anywhere and close anywhere as long as it's between 40 or 50 at expiration, then we make all of our money on this trade. So again, let's look at the stock chart and see how that relates. Okay, so here's our stock chart, and let's say that the stock is currently trading at 45, which is right in the middle of our trading range for this iron condor. So we would actually create a position up here at a 50 strike, and then also simultaneously create a position down here at a 40 strike. And basically what we're saying is that so long as this stock trades anywhere in between these two areas, we make all of our money on option premiums for that month. So the stock could actually rally all the way up near 50. It could stay flat right around 45, or it could even fall all the way down near 40. And as long as it didn't go past 50 or past 40, we keep all of our money. So again, you can see how this is a great market neutral options trading strategy that you can use in your portfolio month after month to create passive income even when the markets are in a kind of flat or sideways non-volatile movement. Alright, the last strategy that we're going to talk about is selling single leg naked puts and calls. Now this is by far the most profitable strategy that we do have here at Option Alpha. It's a very consistent strategy, and the reason is because we are able to get even further away from the markets and reduce our risk. Now all of you who liked credit spreads and liked iron condors, you probably like them because you could get far from the market and have limited risk and still make a good chunk of change. Now naked puts and calls adds another dimension of trading, but they are by far the most profitable trading strategy that we have. So here's the payoff diagram, and this is actually a payoff diagram for a naked put, and this is a naked put with a strike price of 45. So it's a lot simpler than the other two strategies. You're not selling multiple options like you are in iron condors or spreads. And basically what this is saying is that so long as the stock trades anywhere above 45 at expiration, we keep all of our money. So it could trade up to as high as $100 a share. We still keep all of our money. So again, let's go back to our stock chart and see what it looks like. Okay, here's a look at our stock chart. And let's say that the security is actually trading more around the 54 to 55 type range. In this case, we would actually sell a naked put at a 45 strike option here. And what this is saying is that so long as the security trades anywhere above 45, we make all of our money on that option premium at expiration. Now the good thing about selling naked calls and puts is that we could actually sell a call above the market. We could actually sell a call at, let's say, a 70 strike way up above the market and really just bracket the market. So the market could move in either direction, it could even stay flat, and we would make money on both positions. Now again, what's great about selling naked options as opposed to credit spreads or iron condors is that you do have the ability to go a little bit further from the market. If we were actually selling credit spreads with the stock trading up here, we might have to be in here around the 50 strike range to actually get some good premium out of those options. With naked puts and calls, you can actually move further away from the market and reduce your risk even more. As always, that concludes this video, and we'd always like to invite you guys to try us free for 30 days with any of the option strategies that we just talked about, and I'm sure you'll see exactly why these are the most consistent and most profitable option strategies out there today.